Hey everyone, it's Andrew here. So unless you have amazing self-discipline and don't look at the stock prices, I'm sure you have noticed that a lot of the big names coming out of the pandemic have crashed back down to earth. Look, investing has lost its sparkle from those heights of 2020. I can even tell by the number of viewers here on my YouTube channel that numbers are down almost in line with the stock market. And it tells me a few things. Well, one, people are happier and more interested to learn when things are going well. And when things are going badly, well, people don't want to be reminded that they look stupid. There is no reassurance when you are down big in your portfolio. And I think people tend to try to ignore the harsh reality of what is actually happening. And it's just painful to look. It's painful to look at your stocks going down. So it's a true stomach test. And most of my portfolio is down very significantly, so I feel it as well. Some stocks are down more than 60%, like Alibaba and Redbubble. So I'm learning a very valuable lesson here, and that is that I should have listened to Warren Buffett. He says that patience is the thing that separates the average investors from the great investors. Not IQ, not insider information, not perfect timing. None of that stuff's important. It's all about patience. See, I could have easily sat on the sidelines and waited for the perfect pitch to be thrown to me and then taken a big swing. And I actually think I did that with some of my investments. I felt like I understood the businesses, I thought the valuation made sense, I evaluated the risks, and then I went for it. So why do I feel like an idiot? Well, I guess that's just my brain playing tricks on me. I feel uncomfortable about the amount of money I have theoretically lost if I sold everything today. And the uncomfortable truth is that I probably made some mistakes, some costly financial mistakes. And these types of thoughts is where my brain goes, just like everyone else, and I'm sure you feel it sometimes too. But there are a few really easy tricks to feel great about your investments and not worry about the stock prices. And let me go through them with you. So the first thing to do is to actually just get to work and really make sure you have a good grasp on the business. The weaknesses are getting highlighted right now. And this is an amazing opportunity to see how the management team perform and how the business performs. Once you have really understood what difficulties the business is facing, well, then we can move on to the next step. And that is deciding whether these difficulties are actually fatal. Did something happen to the business that has ruined the investment? So let's take Redbubble, for example. The stock price has fallen from $6 to $1, and my position is down from about $3.50 to about that $1. So it feels as though the business is doing really poorly, well, just based on that stock price drop, especially from when I bought it, because when I bought it, I really thought that I was buying it at fair price. So I have to be really honest and think about the things that have actually changed. So for Redbubble, the advertising costs have increased, and that's true, and that eats into profitability, but it hasn't stopped the business from performing. Another thing that's happened is that people are buying from retail stores again, and that's true, but online shopping numbers are still far above where they were pre-pandemic. So is the business bigger than it was 2 years ago? Well, definitely yes. Are customers leaving? Well, no. Well, not at the moment. But this will be the harsh truth if customers do start to leave and that starts to happen. I will have to face that reality. But right now, customers have not left. They are significantly higher than they were 2 years ago. Then I look at the debt levels, and is that going to be maybe some sort of issue at the moment? Well, no, because they have plenty of cash. They have actually $90 million of cash, which is multiple years worth of their expenses. So although there are some headwinds, the business is still running and has a great balance sheet. So am I concerned? Well, yes, of course, but the business is really okay and is just facing less amazing tailwinds than it was in 2020. So I don't believe anything here is fatal. So if the business hasn't hit a fatal issue, then it's time to revalue the business. I want to be really conservative and account for the tough times. I want to face this uncomfortable truth that my previous valuations are probably wrong, and I need to be even more conservative. And for Redbubble, well, after being far more conservative, I think the company in a takeover offer would be worth around $3.50 per share. Now, I've updated valuations on all the companies on my watch list, and I think I'm up to 38 companies now. There's a link in description to my Undervalued e-magazine where I publish this information of my watch lists each month. So once I've gone through the previous points, I now want to change the narrative. And this is the most important point. See, if the company is worth $3.50 per share and I have 10,000 shares, well, the value of my investment is $35,000. And as an owner of the business, I wouldn't want to sell anywhere below this. I probably wouldn't even sell it at $3.50 either. That is what I think the business is worth today, but I think in the future, it could be worth far more. So even though my 10,000 shares, when I look at the current market price, tells me they're worth only $12,000 in total, well, that's just not fair. I think they're at least $35,000. So I have zero interest in selling at this $12,000 number at the moment. When the market offers me a fair price, then I guess I'll think about it again, but now it's just this silly lowball offer. It's exactly the same as someone offering me, say, $100,000 for my apartment when I know it's worth $300,000. I'm not going to accept that $100,000 offer. I'll just wait a few years until a better buyer comes along. Or I might not even sell it if I really like the apartment and I think it's going to keep appreciating. So then for Redbubble and all my stocks that are significantly down, I will just let the business continue working and hopefully grow even further. Actually, as I make some money over the next year or two, these prices are very attractive. Maybe I could be the buyer, increasing my ownership in these companies from people who can't handle this stomach test. The absolute last thing I would want to do at the moment is sell anything. And my main focus is making some money in my other projects so I can then hopefully buy some more shares. Buying more of everything I think is a great company at a great price. And I hope you do the same. I hope you embrace these low prices, and let's hope they go even lower so we can buy even more over the next few years. And I know there is a lot of noise out there. All this market noise is actually really bad for our brains. Let me read a few little bits from this investing.com article to illustrate my point. The Dow fell Tuesday as weaker than expected corporate earnings and ongoing fears of a slowdown in global growth dented sentiment on stocks, with tech leading the sell-off. Mass testing is also underway in Beijing following an increase in COVID-19 cases, which has stoked fears that China's capital could face a Shanghai-style lockdown. Yep, so this is the news why some companies in America are falling in price. Look, the noise is all just silly. It's all quite useless when you think about it from the bigger picture. If we zoom out to, say, a 10-year time frame, the news will be just completely forgotten. This trading day will also be completely forgotten. Do you remember the trading day on October 16th, 2016? Well, of course not. Well, this is when the market had its largest sell-off since the GFC. Now, I don't remember that at all. Do you remember why? Well, of course not. But it was big news at the time, and look, I don't remember what actually happened, but obviously we've forgotten about it. Then to that article, Morgan Stanley added this garbage. Earnings revisions for the S&P 500 has resumed its downtrend over the past 2 weeks and is once again approaching negative territory, which might indicate a continuation of negative revisions. Well, thanks, Morgan Stanley. That was just a complete waste of energy. Anyway, I'm going to suck it up. Embrace the pain. Embrace this stomach test. Do everything I can not to sell a single thing and work my butt off to try to add more to my positions. Now, that's what I think of current market conditions at the moment. I hope you've enjoyed this, and I will see you in the next video.